I'm going to try and explain subprime loans so you actually understand them. Subprime loans are a type of loan given to borrowers with poor or bad credit history. They're often seen as a bit of a controversy in the financial world, and for good reason. These loans can be super tempting for people who are struggling to get approved for traditional loans, but they come with some serious risks. One of the core issues with subprime loans is that they're much riskier for borrowers. Since people who get these loans have a history of not paying their debts on time, lenders charge them way higher interest rates to make up for the risk. This can lead to a cycle of debt that's really hard to escape. Borrowers might end up paying way more in interest over the life of the loan, which can be a huge burden. And if they're not careful, they could end up losing their collateral, like their home or car, if they can't make the payments. Another issue is that subprime loans can contribute to economic instability. When a lot of people take out these loans and can't pay them back, it can cause a ripple effect throughout the entire economy. It can lead to a bunch of foreclosed homes, which can drive down housing prices and hurt the economy as a whole. And when lenders realize they're not getting paid back, they can become super cautious and stop lending to anyone, which can make it even harder for people to get loans. The mechanics of subprime loans are pretty interesting. To qualify, borrowers usually need to have a credit score below a certain threshold, often around 620 or lower. The interest rates on these loans can be way higher than traditional loans, sometimes exceeding 20% or even 30%. This is why it's super important for borrowers to read the fine print and understand exactly what they're getting into. Historically, subprime loans became super popular during the early 2000s, when lenders were handing them out like candy to anyone who wanted one. The subprime loan bubble eventually burst in 2007 and 2008, which played a huge role in the global financial crisis. It was a pivotal moment that showed just how destructive these loans could be. When housing prices started dropping, a bunch of borrowers found themselves unable to sell their homes or make their mortgage payments. This caused a massive wave of foreclosures, which flooded the market with housing inventory and drove prices down even further. To wrap things up, subprime loans can be super risky for borrowers, but they can also provide access to credit for people who might not otherwise qualify. It's all about being aware of the potential pitfalls and taking the time to understand the terms of the loan. With the right approach, subprime loans can be a useful tool, but it's crucial to be cautious and not get in over your head. If you've had any experiences with subprime loans, good or bad, I want to hear about them in the comments. Don't forget to subscribe and hit that notification bell for more videos on financial topics. We're always breaking down complex issues in a way that's easy to understand.